Good morning and welcome to Chapter 6. Chapter 6, we're going to talk about merchandise inventory and how we handle the costing of merchandise inventory. If you recall from Chapter 5, we stepped off and in Chapter 5 we discussed that we're shifting from a service company to a manufacturer to a merchandising company. And merchandising companies buy stuff and they turn around and they resell it. What we're going to talk about now is different ways that we can cost merchandise inventory and how we can expense them as we go through a business. And bear with me, I'm having a little problem with my slides. Okay. First, what we're going to do is we're going to talk about some principles and controls that are related to merchandise inventory. And really, we're talking more about principles and not so much about controls. And these accounting principles that we're going to talk about are going to relate to other accounting things as well. Say, for example, accounts receivable or fixed assets. But this is a good introduction to these controls. So what are the principles and controls that relate to it? What you really have here is several. And remember, what these principles are designed to do is to make certain that we classify the information or we accurately value the information that's on the income statement and on the balance sheet or in the financial statements for a business. And there are consistency, disclosure, materiality, and conservatism. And each one of those has an impact on how you account for inventory for a business. And we'll touch on each one of these just a little bit and talk about some definitions because I think they're important. The first one is consistency. And for those of you that are athletes, consistency would be doing the same thing over and over again. How do people get good at golf? They do it exactly the same way all the time. Well, in accounting, it's a little bit different. Consistency still means that you have to do things the same way. So when you do things the same way, it allows for people, remember, because the goal of financial statements is for external users to look at those financial statements and understand what's going on in your business. Well, if you change how you do stuff and you're not consistent over time, it will have an impact on the financial statements of your business and how they look, right? So you want to be able to report your financial statements in a consistent pattern so that they can compare month over month, year over year, quarter over quarter, etc. And if you don't maintain the consistency, you have to disclose it. It's a requirement that you disclose what you have done with your financial statements and what changes you've made. That's the consistency principle. Disclosure says that the company has to disclose enough information for outsiders to understand what's going on with the business, and that the information is the faithful representation of what's going on within the business. And typically, if you look at a company that's publicly traded, these disclosures will be part of the financial statements. They'll be considered notes to the financial statements, and you'll see one of those here in a minute. But you have to determine and disclose exactly what you're doing and how you're doing it. For example, if you look at depreciation methods, we haven't talked about depreciation much yet, but depreciation methods, you really have three methods: straight line, double declining balance, and units of activity. Well, you have to disclose what you're doing with those, how you're depreciating your assets. And even though you see depreciation expense on an income statement, in the notes to the income statement or to the financial statements, it tells you what method the company is using to depreciate their long-lived assets. And there's an example of disclosure here, and this particular one is about inventory. And it talks about what's in their inventory and the method that they use, and it has FIFO, which is short for first in, first out. And they look at the net realizable value, which is talked about, looking at the carrying value of the inventory and what value it should be on their books at. And they do something called lower of cost or market, and we'll talk about lower of cost or market as we get a little further into this chapter. The materiality concept. Now, you can read all this, but I'm going to give you a kind of an anecdotal example for a materiality concept. Let's say you lost $100. You got $100. Your spouse gave you $100. You got a gift of $100 for graduation. If you lost that $100, what would you do? Would you tear your house up one side and down the other to try and find it? Absolutely, you would. But now let's say Donald Trump lost $100. Would Donald Trump go out and find the real estate billionaire? Would he go out and try and find $100? Probably not, because the $100 might be a tip for his meal for lunch today. Whereas for us, that $100 might buy us lunch for 2 or 3 or 4 weeks. For him, that $100 is just basically rounding. That kind of gives you an idea what materiality is. But now let's talk about it in the context within a business. Materiality basically says that if the information or the number is significant, it would change or cause someone that's external to the company that's looking at the financial statements to make a different decision, then it's material. Now, when I worked at Pilgrim's Pride, our sales were about $8 billion annual. Our materiality threshold was $1 million. That gives you at least a little bit of a perspective. I mean, that's, I don't know, what, 1/4% of sales for the business. So a very low amount, but it gives you an idea, a low percentage, but a significant dollar amount in the world that we live in. So that gives you an idea. Conservatism says that you need to put the least favorable numbers on the financial statements in the business. So you need to make certain if there's 2 options available, you need to make certain that you put the one that's painting the worst picture, not the best picture. And what you want to do is you don't want to have gains in your balance sheet in what you've put in your inventory, for example. What you would rather do is anticipate probable losses, and we're going to talk about that a little bit when we get to something called lower of cost or market. But what we're trying to do is present the lowest possible value of our business, not the highest possible value. So let's use an example that'll help. Let's say you have a car that's 10 years old and it's in kind of bad shape. And you go out and you look at Kelley Blue Book, they value cars or used cars, and you look at Kelley Blue Book, and the Kelley Blue Book says that your car that's in excellent shape is worth $10,000, but then if it's in poor shape, it's worth $5,000. Well, if you're following conservatism in accounting, you would put that car on your books for $5,000. You would not put it as $10,000 because $10,000 would overvalue that car. That's the basic concept of conservatism in kind of in an illustrated way. What are some of the controls? There's controls over merchandise inventory, but what they're really talking about here, and I'll give you another example of this, is making certain that the purchases of inventory are authorized and that the value of the inventory is correct. And this is kind of a summary, and you do analysis of the inventory when it comes in to make certain everything is correct. So if any of you have ever worked, say, at a convenience store, or if you worked at a business where a supplier brings stuff in, one of the first things you do is you count everything that they brought in and check it back against the invoice that they brought to make certain that they didn't bring you too much stuff, or they brought you stuff that they didn't invoice, or vice versa, that they invoiced you for stuff that you did not get. Because if they do, then it's a straight loss. So what you want to do is make certain that when the inventory comes in, that you got what you ordered and it's at the price that you ordered. And there's something called matching for some people that work in accounts payable. They'll have what's called a purchase order, a receiving report, and then they'll have an invoice, and they match all 3 of those to pay. But then what you also do is there's physical counts of inventory, and it says here annually, but that's not really true. A lot of businesses will cycle count their inventory maybe once a week or once a month. And what a cycle count will do is they'll count, if they have a store, like say, for example, Sally's Beauty Supply, they will count the whole store within a month. They'll start and they'll say we have 1,000 items, so we're going to count 30 items or 35 items a day. So by the end of the month, we've counted all 1,000 items. And what they're doing is they're comparing that count to a perpetual inventory amount that they have as they're keeping track of inventory. When they sell you something, they're going to take it out of inventory. That's perpetual inventory. And so they want to take stuff out of merchandise inventory when it's sold. That's when they scan it. So that's what they're doing in a perpetual inventory system. So we're going to talk about how they account for inventory in a perpetual inventory system. This is something that's a bit confusing in this chapter, but I'm going to try, and I don't know if I'm going to get way deep into this, but we'll talk about it just a little bit. What this chapter is trying to do, excuse me, is they're trying to mimic what would happen within a computerized system when they scan stuff out in the timing. So if you brought stuff in on the if you have stuff in the beginning inventory, and then you brought some more inventory in, and you sold part of it, you want to take that out of inventory. And then if you purchased more, you want to continue to take out depending upon the model, last in or first out, you want to continue to take stuff out of inventory. So here's what they do for a perpetual inventory. The merchandise inventory is the number of units, physical units that the business has on hand, and you're going to take that times the unit cost, and then you're going to look at also the cost of goods sold, and you're going to take that times the unit cost, and determine the cost of goods sold, and also to determine what value you have product and inventory at. So here's just a simple example, and really that's the way this works. As far as cost of goods sold is when they scan something out of inventory in a perpetual inventory system, they're charging it off as an expense. So here's kind of an example of how you determine inventory under a perpetual inventory system. You notice that each unit originally cost $350, yet an ending in, and it's easy in this case because they're all the same value. And so what happens is each one costs $350, and so we had how many units on hand at the end? Well, we had a total of 4 on hand at $350. So we're going to multiply 4 times $350, and that's $1,400. And our cost of goods sold, we sold 14. So we're going to take 14 times $350, and our cost of goods sold is $4,900. That one's really easy. It gets more complex as we go. We'll talk about it. Now, how do you do that? If the inventories are different, you almost have to track each one as you go. So let's look at this just simply. If we use something called the first in, first out inventory model, which we'll get to a little bit later. Right now we have 2 inventories here of 2 and 6. So we have a total of 8, but we sold 4. So when we calculate our cost of goods sold, we're going to take 2 out of this first group, and we're going to take 2 out of the second group. So it's going to be 700 plus 720, which is 2 times 360 and 2 times 350, to account for this sale. So it's going to be 700 plus 720, or 1420 when you make this sale. And likewise, you do the same. You do the same when you sold 10 here. You're going to take 380. You have 4 left from. You'll have 2 left from this group, and then you're going to take the other 10 out of this group. And let's go through that a little bit. We'll talk about that as we go. All right, now we'll talk about that a little bit more as we go and how it works. But there's really 4 types of basic inventory. The first one is called specific identification. Specific identification, 2 prime examples I can give you would be a company that keeps track of, say, cars. Cars are kept track of using a vehicle identification number. That's going to be a VIN number. They specifically identify each and individual car. First in, first out inventory. Think about that when you go to Walmart and you buy a gallon of milk, and they have a rack system that slides forward that makes you have the oldest milk comes to the front, and the newest stuff is in the back. And typically, what do? You reach towards the back, and you take the one that has the date, the newest date, so that'll have the longest life. Last in, first out. Sometimes the examples that I get from you guys is inventory that like computers and cell phones. Those are going to be last in, first out sometimes. And then weighted average is just taking the average, not a simple average, but a weighted average. So specific identification, we touched on this. They know exactly what it is, and it has automobiles, artwork, jewels, real estate. Think about Rolex watches. That's another example. So they know exactly each item, and they track it that way. So here's what you do. And I'm not going to go through these. These are ones you're just going to have to spend a little bit of time with. But this is how much cost they have inventory cost on hand for each one, and as they sell it. So let's just start with 1 for specific identification. So we had at the beginning, we had 2 units at $350, so we have a total of $700 in inventory. We bought another 4 times 360, or $14,400. So we have this much in inventory right now. So we have 2 units and 4 units. And remember, what this is doing is it's mimicking what would happen within a computerized system. Then we sold the units, and we're going to use the specific identification of units. It doesn't really tell you that. It's not very clear here, but we sold 1 unit at $350, and then we sold another 3 units that had a cost of $360. So we're not going down and actually taking out, like taking the first 2 units at $350. We're taking one from the group that cost $350. So maybe that was one Rolex watch. And then you're taking the other ones that came in a little bit later and taking those out. So there's no pattern to these. It's just individual units, and they would take them out based off of their serial number. So that's a little bit different. First in, first out is basically we're going to take the oldest ones out first. But I want to be clear that you can actually have inventory. You can use a costing method that is different than the physical flow of the product. But it's basically something that you're going to cost out the oldest ones first. So if we look at this particular example, right? Now what happened here, remember on the other one for specific identification, this looks the same. But now what happens? So we sold 4 here, right? But when we sold 4 right here. But when we sold 4 units, we sold 2 from the units that we sold 2 at $350 and 2 at $360, so it's $1420 is our cost. So we're taking the oldest ones first. So we're taking these 2 first, then we're taking 2 out of this group. So now we have 2 that are left at $360, and this is our perpetual inventory. And then when we sell these other 12, when we brought another 12 in, so now our perpetual inventory is 14, but we sold 10. But when we sold 10, we had 2 that are from this 360 group, and 8 are from the 380 group. So here's your cost of goods sold, and here's your inventory on hand. And these 2 come up to available for sale. LIFO is the opposite of FIFO. It's just going to work from the bottom up, and you're going to do cost of goods sold that way. And I'm not going to spend a lot of time on this. This is just something you're going to have to analyze to look at. But LIFO is last in, first out from a valuation perspective. So it's going to work upwards here. So let's look at this example again. We sold 4 units at $360. We sold 4 units, but we're starting with the last in, first out. So we're going to take these 4 units and take the $360 off of these. So now I only have 2 units left in inventory in my perpetual, but they're from back here in August 1st when we brought those in. But now when we sell the next ones, we don't have any other ones. So we're going to show the 2 units. When we sold these 10, we're still going to use last in, first out. So we're going to take 380 from this purchase of 12, and we're going to take 10 of those units. So now at the end we have 2 units from this grouping, and the 2 units up here from way back on August the 1st, from a first in or last in, first out model. And the weighted average computes a weighted average. It takes the value of your inventory or value of what you have to get all together and divides it by the number of units to come up with the weighted average. And this is how it looks. And it's called goods available for sale, which is purchases plus your beginning gives you goods available for sale, divided by the units gives you the average cost per unit. So our goods available for sale is the sum of all these. And if we had a beginning inventory, you would add that. So we have 6,000 units. We have our goods available for sale. It doesn't show you the calculation, but what you're doing, and remember, we're doing this in a perpetual inventory system. So you have a weighted average here, and you have another weighted average here. And you're making that calculation. Let's take a look at what happens when inventory is wrong. If you have a mistake in inventory, the impact, not a mistake, but what happens on different things with inventory. So how are financial statements affected by different costing methods? You notice that, and I want to point out one thing here really quickly. See here it says when costs are rising. When costs are rising, okay? When costs are rising, LIFO has a higher cost of goods sold. Why does it have a higher cost of goods sold? Because you're taking higher values of inventory out and reporting them as cost of goods sold. When costs are and also what happens is net income is lower, because remember, you're taking sales less cost of sales or cost of goods sold, and it's going to give you a net income. But under LIFO, you're going to have lower valued inventory, or I mean, you're going to have higher costs that you're taking through your income statement, and therefore your income is going to be less. And if your income is less, then your income tax is less as well. And now let's look at the last part. So remember, we talked income statement, not balance sheet. When costs are increasing, FIFO inventory will be the highest because you're taking out the lower, and LIFO inventory will be the lowest because you are taking out the most expensive inventory and keeping the cheapest one in. Just remember always, if LIFO, the cost of goods sold is going to be higher and inventory is going to be lower with rising costs. And of course, if you flip that equation and you said if prices are falling, then it's going to be just the opposite. You might take a moment to write that down to get it in your head. And you notice here, remember, we're still talking about periods of rising prices. And it says FIFO, first in, first out, is going to take the cheapest inventory out first, so it's going to have the highest value. And LIFO is going to give you the lowest because you're taking the most expensive. And by extension, if you had taxes that you paid on these, because these numbers are in relation to the taxes and you're going to take a percentage, FIFO is going to give you the highest income tax and LIFO is going to give you the lowest income tax. A lot of businesses will determine that they want to use LIFO because they think it's a better matching of revenues and expenses. So you might see that. And a lot of them use average because they don't want to distort their financials based off of the cost of goods and they don't want major fluctuations. So here's another look. And this really, we haven't talked about this in this chapter yet, but this is really kind of what I would call a periodic inventory model. Okay? And even though they don't do it this way, this number, the only difference here is if you're using periodic inventory, you would subtract a physical ending inventory to come up with cost of goods sold. These would be the reverse. Okay, but you can kind of see what they look like and how they're ending inventory based off of the comments we made earlier. And I'm not going to go through this table. It's just something that I think if you're trying to figure some of this stuff out, this will help you. And this will probably help you with some of your quizzes and your exams. But I just think you need to look at it and try and understand at least a little bit of it. And to me, what makes more sense with some of this is to make a numeric example. That helps you in a grand way. Okay, lower of cost or market is part of conservatism in accounting. Why is it part of conservatism? Let's say you have something that you know is going to fall below the market value, that what you can really sell it for in the open market. For example, let's say you had an iPhone 3 still in inventory. You're the Verizon company and you have the iPhone 3 and you still have it in inventory. And all else equal, if you're trying to sell that product outside, I guarantee you the value that you have in an inventory at is going to be much greater than the value that you could sell it to a customer, because nobody wants an iPhone 3 anymore. Or those flip phones, maybe a flip phone. Or if you have a VHS recorder, which I know some of you guys looked at when you were kids, or you have kids that looked at it. The VHS recorders and the VHS players, if they're still in inventory, there's no way they're going to be able to, what they paid for them and what they can sell them for are different. And that's what we're talking about here. And it says that inventories need to be carried at a lower of cost or market. And that relates to the rule of conservatism. So you have to do a calculation for that. And when you write that stuff down, what you're going to do when you write your inventory down at a lower of cost or market is you're going to debit cost of goods sold and you're going to credit merchandise inventory. But you would never write it back up. So that, let's say this inventory changed and the inventory value went back up for some reason, because there's a new market or something happened with supply and demand, you would never go from $2,200 to $3,000. And in business, where it takes the lower of cost or market number, this 800, and charges it directly to merchandise inventory, they might put it in an account called the lower of cost or market adjustment. They might isolate that into its own separate and distinct account. It makes for understanding the financial statements better for a business. What's the impact on inventory errors? The only thing I'm going to tell you with inventory errors is 2 wrongs make a right. If you have inventory wrong in one period, if you have the ending inventory wrong in one period, the beginning inventory is going to be wrong in the next period. But if the beginning inventory, so let's say it's January and February, If your beginning inventory for January is correct and your ending inventory is incorrect, no matter which way, and so that means your beginning inventory for February is incorrect. But if your ending inventory in February is correct, then your financial statements year to date through February are going to be correct. It's just that January and February are going to be incorrect. And we can look at a table here and we can understand what happens. So for this example, it says ending merchandise inventory overstated by 5,000. So if it's overstated by 5,000, that means your cost of goods sold is understated and your gross profit is overstated. Your operating expenses are good, but your net income is overstated by 5,000. But if you go to the next month and you make the correction and you figure out you made a mistake, then what happens is it's going to correct itself. And here's the understated. If inventory is understated, cost of goods sold is overstated, and then it flows all the way through the income statement. So here's what we're talking about from the periods, where each period one goes to the next. And so if you have a mistake in one, it's going to go to the next, but it ultimately washes itself out. That's what this illustration talks about. So here's a sample example of what we just talked about, and you can read through this and understand this. I'm not going to spend time here. And a couple more things we're going to talk about. Inventory turnover. You hear this term pretty regular where they say they've turned their inventory over. What it really tells you is to try and figure out how much inventory you're selling relative to your sales. If you want to have a high inventory turnover, that means you're generating profit. And you can look at the top, it says inventory turnover is cost of goods sold by average merchandise inventory. And you can see how average merchandise inventory is calculated. And why is that important? Because every time you sell something, you're either going to make money or lose money. And you don't want to have stale inventory. That's why when you go look at a car dealership, they're willing to, towards the end of the model year end, like now, they're going to probably be willing to try and sell any 2015s that they have still sitting on their lot. Because if they do, then they can put new inventory and turn their inventory over. A lot of used car lots want to do this. They don't want to have old cars. I mean, not old cars, but cars that have been sitting on their lot for a long period of time. They want to sell them and turn them into cash, because if they turn them into cash, they can make more money. If they don't turn them into cash, they're not going to do that. And what you'll do is benchmark these against industry averages to see where you stand as a business. And days sales and inventory says, how much inventory do you have? Inventory companies do not want to build up their inventory too big, because if they do, what happens is they can't sell the stuff, and they want to move it. They want to move it faster, and particularly stuff that has a date code on it. So those are things that they want to do. And this is a formula for day sales and inventory. And finally, we're going to talk about this last part. And I want, even though this is the appendix and it's at the end of this discussion, this is a formula, or this is something that you're going to need in Principles 2 when you take it in the spring. It is a periodic inventory. Remember, we've talked specifically about perpetual, and we've talked about periodic in Chapter 5, but I'm going to talk about periodic again. And remember, periodic says take the beginning inventory plus your purchases. It gives you goods available for sale, which is net purchases, less your ending inventory gives you cost of goods sold. And purchases are accumulated for the period, and that's what we're going to do for a periodic inventory system. So here's the perpetual inventory record that we looked at from before, but we're going to use it for periodic. And what you have is you have a beginning inventory plus all of your purchases gives you your goods available for sale, and this is first in, first out. And then, so all they're really doing in this particular model is they're valuing the ending inventory based off of that last record. You might need to go back and look at it, but this is what's available. They had this much when they started. They brought in another 6,000, so they have 6,700 available. And their ending inventory, they're looking at only from that last grouping of inventory that came in that they paid $380 for. So their cost of goods sold is 380 times 4. Or 1520, so they have 5,180 is their cost of goods sold. So it's real critical to look just at this number, okay? Because that's from the last purchase. Now, if we go, because the rest of them have gone out of inventory, and we can prove this out another way as well. That this 5,180 would be 2 units times 350, 4 units, and then the other units that you sold. So it looks like they have a total of 16. So they sold 12 total. So they sold 2 from this group, 4 from this group, and 6 from this group. And if you multiply those times the cost, it's going to get you 5,180. That's another way to get there. FIFO is just LIFO is just the reverse. You notice now your ending inventory is the first 2 units, the beginning inventory, plus the original purchase from this one here. So these 2 are represented by this 350, and these 4 are represented by 2 that are 360, and that's how you look at that. And the average cost is simply taking the average cost of the units, 6,700 divided by 18 total available, and it gets you 372.22. And 372.22 is your ending inventory, so the rest is your cost of goods sold. And that's it for chapter 6. This chapter is a little bit challenging, particularly with perpetual inventory stuff. Don't get lost in the weeds on that and take your time. It's a little bit of a process. Remember, they're trying to mimic in this chapter. What they're trying to mimic in this chapter what it would look like in a computerized system, and it's really a major challenge. I hope all is well with you, and I hope you have a good day. Thanks. Bye.